How does the Fed use open market operations? Have you ever wondered how the Federal Reserve influences the economy? One of the key ways it does this is through open market operations. Let's break it down. Open market operations are the buying and selling of United States Treasury securities. The Federal Reserve uses this tool to control the money supply and affect credit conditions. When the Fed buys Treasury securities, it puts more money into the banking system. This action increases the reserves that banks hold. More reserves mean banks can lend more money, which can lower interest rates. Lower interest rates make it cheaper for people and businesses to borrow money, encouraging spending and investment. On the flip side, when the Federal Reserve wants to reduce the money supply, it sells Treasury securities. This sale takes money out of the banking system, lowering the reserves banks have available. With fewer reserves, banks lend less, which tends to raise interest rates. Higher interest rates can slow down borrowing and spending, helping to control inflation. The Federal Open Market Committee sets a target for the federal funds rate. This is the interest rate at which banks lend reserves to each other overnight. The Federal Reserve uses open market operations to adjust the supply of reserves to keep this rate close to the target. This rate influences other interest rates in the economy, affecting everything from consumer loans to mortgages. Since the financial crisis in 2008, the Federal Reserve's approach to open market operations has changed. Before the crisis, the focus was on fine-tuning the federal funds rate in a tighter reserve environment. Afterward, the Fed adopted a strategy of maintaining a large supply of reserves. It now uses administered rates, like the interest on reserve balances, to influence market interest rates more directly. There are two types of open market operations. Permanent operations involve outright purchases or sales of securities. These change the Federal Reserve's holdings and the total level of reserves permanently. They help accommodate long-term trends in currency demand and influence longer-term interest rates. Temporary operations include repurchase agreements and reverse repurchase agreements. These are used to temporarily add or drain reserves to manage short-term fluctuations in the banking system. The New York Federal Reserve's trading desk conducts open market operations under the direction of the Federal Open Market Committee. This team adjusts the supply of reserves to achieve the desired federal funds rate target and broader monetary policy goals. These goals include controlling inflation, supporting employment, and promoting economic growth. In essence, open market operations are a vital tool for the Federal Reserve. They help control the money supply and influence interest rates, which are essential for managing economic activity. Understanding how these operations work can give you a clearer picture of how monetary policy shapes our economy.